Hello, I'm Haider Malik, host of the Mehmi Financial Group podcast. Today's topic is funding Atlantic routes, factoring for Halifax trucking fleets. When extended payment terms and seasonal lulls strain your cash flow, invoice factoring can be the engine that keeps your trucks and your business moving east and west across the Maritimes. 1. What is invoice factoring? You sell approved customer invoices to a factoring company. The factor advances 80 to 90% of each invoice's face value within 24 to 48 hours. When your customer pays, the factor remits the remaining balance minus a fee, typically 1 to 3%. 2. Why Halifax fleets benefit. Speed to cash. Access funds immediately to cover fuel, bridge tolls on the Cobequid Pass, or crew payroll when brokers extend 30 to 60-day terms. Growth capital. Deploy working capital into additional tractors or seasonal drivers during lobster and seafood peaks. Outsourced collections. Let the factor manage follow-up and disputes while you focus on routing, compliance, and safety. Credit risk protection. With non-recourse factoring, you're shielded if a shipper becomes insolvent or refuses payment. 3. The factoring process. 1. Onboarding. Apply and receive approval based on your customer's credit profiles. 2. Invoice submission. Forward your signed, accurate invoices immediately after each delivery. 3. Advance. Receive 80 to 90% of invoice value, often within 2 days. 4. Collection. The factor pursues payment from your customer under agreed upon terms. 5. Remainder. Upon receipt, you get the residual 10 to 20% minus the factoring fee. 4. Choosing the right factoring partner. Industry expertise. Select a factor familiar with Atlantic Canada logistics, understanding holdbacks, detention charges, and fuel surcharges. Advance rates. Higher advances up to 90%, free more capital, but ensure fees remain competitive. Fee structure. Negotiate tiered rates that decline as your monthly volume grows. Recourse versus non-recourse. Decide if you need protection against non-payment. Non-recourse is pricier but offers peace of mind. 5. Best practices for Halifax fleets. Timely invoicing. Issue clean, detailed invoices right after drop-off to avoid verification delays. Customer notification. Inform customers about the factor's involvement to smooth payment routing. Hybrid financing. Blend factoring with a receivables-based line of credit or ELOC for maximum flexibility. Cost monitoring. Track factoring fees as a percentage of revenue to ensure ROI justifies the expense. 6. 3 action steps. 1. Audit receivables. Identify your top 5 customers by volume and payment reliability. 2. Solicit term sheets. Request proposals from at least 2 factoring firms. Compare advances, fees, and recourse terms side by side. 3. Model cash flows. Simulate weekly fuel and payroll needs against factoring advances to confirm capacity and coverage. Invoice factoring transforms slow pay invoices into working capital, enabling Halifax trucking fleets to seize seasonal opportunities, expand routes, and maintain optimal operations, and it does so without adding long-term debt. If sluggish payments threaten your Atlantic Canada network, factoring may be the solution that fuels your fleet's growth and resilience. I'm Haider Malik. Thanks for listening.